Today, we're going to talk about 5 changes Canadian retirees wish they had made at age 55. After years of helping people retire comfortably, we found that these changes can make or break your retirement. And with retirement approaching fast, it's important to know what to look out for so you can prepare properly. That's why we're making this video today, so you can use these changes to your advantage and adjust your plan before it's too late. Let's get right into it.
So John, what are the 5 changes that Canadian retirees wish they told themselves at age 55?
Well, it's become a pretty common thing with a lot of our clients. So we're always interested to see what would you have done differently. And one of the biggest ones that comes up is familiarizing yourself with the Canadian retirement benefits like the CPP or old age security and what eligibility looks like, what the application process looks like, and also what you could receive. This is a very important part of your retirement income, and absolutely you should be taking advantage of it earlier on. The second part was diversifying and rebalancing your portfolio regularly. This is something we often have conversations with our clients about. You need to stay on plan. Allocating investments across different various asset classes, such as stocks and bonds and real estate, and really spread out the risk. The third one was maximizing contributions to retirement accounts. Absolutely, people should be taking advantage of contribution limits for RSPs and TFSAs. It's the ability to maximize tax-free or tax-deferred growth. Every person should be taking advantage of that leading up to retirement. The next one was paying off high-interest debt and focus on eliminating debts with high interest rates, such as credit card balances, personal loans. This just helps free up unnecessary expenses during retirement and really frees up cash flow when incomes are going to be changing when you get into retirement. So if you can't change the income, so you got to bring down the expenses leading into retirement. And lastly, one of the ones that not a lot of people think about is planning for additional healthcare expenses. This should be something that's absolutely budgeted for when you get into retirement. Potential medical expenses, maybe not covered by provincial health insurance. That could be prescriptions, that could be dental care, vision care, whatever it may be, but at least being prepared for that in advance of your retirement. Now, in regards to all of these different changes, why do you think it'd be so important for someone at age 55 to prepare for these things? And really what would happen as well if, this is one of those things that you do ignore?
Well, John, if we're talking about retirement benefits such as CPP and old age security, it's really important to know those things when you are entering the time that you could receive them. At age 55, you still have at least 5 years before you can start taking the benefit. Well, CPP anyways. So you have that time to adjust your savings or determine if you'll work longer to maximize benefits. Now, if you don't understand when or how to claim benefits, you could make mistakes and miss out on higher payouts or face unexpected reductions due to the early withdrawals or going past different income thresholds. Now, when it comes to diversifying, rebalancing your portfolio, your risk tolerance may change as retirement approaches. Diversifying ensures you're not overly exposed to market downturns while you're still allowing for some growth. By regularly rebalancing, you keep your asset allocation aligned with your retirement timeline. Also, one thing that we want to manage is over-concentration in volatile assets like stocks, because it could lead to major losses before retirement, while being too conservative could mean you're not keeping up with inflation. Mm-hmm. Now, we talked about maximizing contributions to your tax-deferred and tax-free accounts. At age 55, you've still got time to maximize your RSPs. Yep. TFSAs, you'll always have the opportunity to maximize. Every year you get that new contribution room. You want to be adding to your retirement nest egg. You may reach retirement, if you're not maximizing those accounts, you may reach retirement without enough funds to be able to supplement your other income sources like CPP and OAS. Now, we talked about having high interest debt. Entering retirement with high interest debt can eat away at your fixed income, and it makes it harder to maintain financial stability. You could end up paying thousands in interest over the years, which would reduce the amount of money available for those essential expenses or retirement enjoyment like travel or all of the different hobbies that you'll have in retirement. Lastly, healthcare costs tend to increase with age, and provincial healthcare doesn't necessarily cover everything. Having a plan ensures you won't be blindsided by unexpected medical bills. Those unexpected medical costs, likely long-term care, prescriptions, or dental work, could force you to dip into savings and deplete your retirement funds much faster than anticipated. Now, we appreciate understanding government benefits is a pretty tough task with what feels like new changes every week. However, it's crucial to fully understand how these benefits could impact your current situation. Unfortunately, we can't cover all of the ways these changes could impact your retirement plan in this video, as we have to move on to the next point. But we have put together a video on our website that walks through our 3-stage retirement planning process that shows you the most important questions you need to answer to ensure you're ready for retirement. To watch the video, click the first link in the description. Now, let's get back to the video.
Now, a lot of these changes that we're recommending in the video today is a lot of what we see with probably the average Canadian in terms of our clients that we've been working with. And a big issue is a lot of people are really great in living in today and doing everything that they need to do for their business and personally and for their house for the next week or 2 weeks or 3 months down the road. But where people really begin to fall short is what to expect way down the road, whether it be 10, 15 years, 20 years, whenever that retirement does expect to come. And we see that pretty regularly, with a lot of our clients coming in, but one particularly stands out. This couple was incredibly successful. They had done very well within their business. They earned a very good living. They still were doing savings to the RSP or tax-free savings account, but there really was no direction. They were saving because they had excess amount of funds and they decided to put into their RSP or TFSA or whatever they seemed fit, but there was no real plan for after work was gone. And this is something that I think that we see pretty frequently. A lot of people can't imagine their life without work. And it's interesting to say, but over 30 years of being within the workforce and earning a paycheck, it's tough to imagine what things will look like beyond that. And with this couple in particular, it's structuring that plan of what you need to do today to make tomorrow look a little bit better. It may still mean making RSP contributions, but maybe you're making a little bit more, or maybe you're directing more to the RSP and less to the TFSA to focus on that cash flow. That's going to be something that we want to focus on when we get into retirement. So there's every little subtle steps that you can take today that is just going to have 10 years, 15 years, 20 years from now as priority. That's the subtle difference and the subtle change that not a lot of Canadians really think about.
And I think that's the big difference when you're working with a financial planner versus an investment management person or a financial advisor, perhaps working at a bank or another institution, is that the important piece or the bread and butter of what we do is creating that plan. And we always go back to it. And the plan is important because it puts you on a roadmap of what you need to be doing to achieve your goals. Now, for this couple in particular, they were successful in their business. It could be another couple who are high income earners. But being a high income earner or having a successful business doesn't necessarily mean you're going to have a successful retirement. You stop working, you lose your employment income, or you sell your business and you don't necessarily manage those investments correctly, and your expenses stay high, you may not be able to maintain that desired lifestyle expense that you were used to when you were working. So again, we have to take advantage of putting money aside, putting into your RSPs, putting into your TFSAs, providing a balanced portfolio that is not going to expose you to an industry or a geographic region or a specific company that does very poorly at the time that you're about to retire. We want to spread the risk, like you mentioned earlier. Right. You want to plan for unexpected health events by either getting into a life insurance policy or a living benefit policy like a critical illness or disability. All of those things are part of a holistic plan that if you're just working with somebody and you're trying to find the best investment and crossing your fingers and hoping by the time you retire, it's a certain amount of money, if you don't know how much income that pile of money is going to provide for, then you could find yourself in a position where you've exhausted all your assets and all you can look forward to are the CPP old age security benefits that we talked about earlier.
After seeing how we helped our client implement these changes, we hope you understand how important they are, especially if you're 55. However, we also hope you noticed while us working through our client's plan, how every little detail can impact how you utilize these changes. If we don't fully understand their exact situation, it leaves a lot of room for error. And when it comes to planning for the most important phase of your life, it's critical to eliminate any chance of making these mistakes. To ensure you're making the right decisions when it comes to adjusting your plan, we created a free video for you to watch. In it, we give you everything you need to analyze your current plan, find areas of opportunity, and use our very own system to safely make these changes for your retirement. That way you feel 100% confident your plan is built to last. To watch it, just click the first link in the description.